Something unusual is happening in Silicon Valley, and it's not the typical startup gold rush. It's quieter, more calculated, and it's reshaping how the next generation of AI companies are being built. It's called the AI roll-up strategy, and it might be the most powerful play in venture capital right now. While most people are focused on flashy billion-dollar AI models and mega rounds from OpenAI or Anthropic, behind the scenes, investors are quietly stitching together smaller, specialized startups, merging them into lean, integrated AI platforms. It's a strategy that's been used in industries like healthcare, logistics, and media before. But this time, it's being applied to artificial intelligence, and it's changing the landscape fast. Let's start with what a roll-up actually means. In simple terms, a roll-up is when investors buy or merge several smaller companies in the same sector to create one stronger, more scalable entity. Instead of building one big company from scratch, they combine multiple niche players, each with unique capabilities, teams, or customers, into a single dominant platform. In AI, that might mean merging a model optimization startup, a data labeling firm, and a vertical-specific app builder under one roof. On their own, those startups might never reach massive scale. Together, they can compete head-to-head with much larger firms, and often at a fraction of the cost. So why is venture capital suddenly obsessed with AI roll-ups? Because the economics of AI are shifting. The early AI boom was all about model development, huge R&D budgets, giant data centers, and foundation models trained at staggering cost. That game is now dominated by a few players: OpenAI, Google DeepMind, Anthropic, Meta, and a handful of cloud providers. Competing at that level is almost impossible for startups. But the layer above those models, the application and deployment layer, is fragmented and full of opportunity. There are hundreds of small startups building AI tools for law, healthcare, logistics, content, customer support, and more. Many of them have promising technology but limited revenue or market share. That's where roll-ups come in. Instead of backing one company per category, VCs are now quietly buying up clusters of startups in related areas and merging them into one ecosystem, with shared infrastructure, shared data pipelines, and centralized go-to-market teams. It's efficiency through consolidation. Think about what that looks like in practice. A venture firm might acquire 5 different startups focused on enterprise document automation, one doing legal contracts, another focused on healthcare forms, another on invoices. Alone, each has limited reach. Together, they can build a unified AI engine that handles any document type, instantly multiplying their potential customer base. Then, instead of running 5 separate backends, they share one model stack, one data pipeline, and one enterprise sales team. Costs drop, margins rise, and the business suddenly looks like a scalable SaaS giant instead of 5 small experiments. That's the quiet genius behind AI roll-ups. You're not betting on a single moonshot. You're assembling a machine that prints efficiency, and the timing couldn't be better. Right now, valuations for many early-stage AI startups are cooling. The hype of 2023 and 2024 pushed some companies to billion-dollar valuations before they even had stable products. Many of those same startups are now struggling to raise follow-on rounds or find product-market fit. That creates the perfect environment for consolidation. Funds with deep capital, especially private equity-style venture firms and corporate investors, can swoop in, buy distressed but promising startups at a discount, and merge them into something far more valuable. We're already seeing it. Firms like Andreessen Horowitz, Thrive, and General Catalyst have been backing AI portfolio clusters that increasingly overlap. Meanwhile, corporate players like Salesforce Ventures and Microsoft's M12 are building roll-up-style portfolios in customer service automation and AI productivity tools. In other words, this isn't theory. It's already happening. But the real strategic advantage of AI roll-ups isn't just cost savings. It's data advantage. When you merge multiple AI startups serving similar industries, you inherit all their data, labeled, proprietary, and often from high-quality enterprise clients. That combined dataset becomes a gold mine. In the AI arms race, the most valuable asset isn't necessarily the model. It's the training data that shapes it. By merging, roll-up firms can pool datasets that competitors can't easily replicate. That allows them to fine-tune models faster, adapt to new customer segments, and build performance advantages that compound over time. This is why you're seeing roll-ups in sectors like healthcare, finance, and logistics, areas where access to domain-specific data is hard to get. A single startup might have 10 hospitals worth of patient imaging data. But combine 5 such startups, and suddenly you've got hundreds of millions of labeled images, a data set no one else can match. That's how a roll-up turns into a data fortress. Now there's another layer here, a strategic one that's easy to miss. Roll-ups give investors exit flexibility. A single small AI startup might not attract major buyers or IPO potential, but a combined entity with multi-sector exposure and recurring enterprise revenue? That's far more attractive to acquirers like cloud providers or software giants. In other words, roll-ups are an exit strategy in disguise. They turn fragmented AI niches into packaged platforms that can be sold to the highest bidder. It's not unlike what happened in the early internet era, when large digital media groups started rolling up niche content sites, or when SaaS conglomerates like Constellation Software built empires by buying dozens of smaller applications. The difference now is that the product is intelligence itself. Of course, not everyone's convinced this strategy will work smoothly. The biggest risk in AI roll-ups is integration. Merging teams, tech stacks, and models isn't easy. Many startups were built using entirely different frameworks. Some on OpenAI, others on Anthropic, others on open-source backbones like Llama or Mistral. Making those systems talk to each other can be messy. There's also a cultural challenge. Startup teams are small, mission-driven, and often resistant to being absorbed into larger entities. Many founders who sold their companies in roll-ups have left within a year, taking valuable knowledge with them. So far, only a few firms have managed to pull off AI roll-ups successfully. And they tend to be those that operate like operating companies, not just investors. They actively manage, integrate, and refocus teams under a shared roadmap. Still, the momentum is unmistakable. As AI markets mature, the days of endless standalone startups are fading. The new phase is aggregation, combining the pieces into scalable, defensible ecosystems. And for venture capital, this marks a quiet evolution. The traditional spray and pray model of funding dozens of startups and hoping one becomes a unicorn